$100,000 divided by 360 months, or $1,389 each month. That's a tall order for most people. You'd better earn more than nothing if you're going to make this happen. Fortunately, you have 30 years to accumulate your goal of $500,000, and we know that time is a powerful ally when we save. Applying the formula for calculating annuities that I mentioned in Lecture 6, we can figure out that you need to save a little less than $500 each month if you can earn 6% annually after taxes. That $500 might still seem to be out of reach, but it's a lot easier to save $500 a month than $1,389, and you can reasonably expect to earn 6% after taxes if you invest in stocks. No promises, of course. If you can manage to find that $500 each month, then you probably don't need to do anything dramatic to reach your goal. You may not even need to invest the entire $500 in stocks, because many experts will tell you that expecting a 6% after-tax return on stocks is on the conservative side. If you can't manage to save $500 a month on your current income, then something has to give. We learned how important taxes are in Lecture 14. Do you think that you can reduce your taxes so that you can earn 8% after taxes instead of 6%? If so, then you can reach your goal by investing just over $335 a month. Better yet, if you can put your investment into a Roth account, then you'll earn tax-free income, and a 10% expected return is reasonable based on historical averages. Again, no guarantees. An annual return of 10% would lower your monthly savings requirement to just over $220. Counting on earning more than 10% after taxes annually without taking even more risk than the stock market offers strikes me as overly optimistic. Oh, it could happen, but I wouldn't count on it. That means that if you can't make these numbers work, then you're probably going to have to make a lifestyle change, like getting a second job, or planning to work an extra couple of years, or reconciling yourself to making do with a smaller nest egg. Better to learn that now than to be surprised later. In our example, we should be glad that we have 30 years to accumulate our nest egg. Remember way back in Lecture 1 when we said that saving and investing is like planting a tree or dieting or exercising? We said that although the best day to start was 15 years ago, the second best day is today. You can still do yourself a lot of good by acting now. Deciding to invest in stocks is part of a larger investment decision called asset allocation. Choosing your asset allocation means deciding what proportion of your wealth you want to invest in stocks, bonds, real estate, and safe assets like treasury bills. One famous study of 82 pension funds found that over 90% of the variability of returns traced to the fund's asset allocation. That leaves less than 10% that depends on the specific stocks and bonds the fund held. Do you know why? The main reason is that stock returns are more variable than bond returns and vastly more variable than treasury bill returns. If returns on bonds and bills vary just a little, while stock returns vary a lot, then almost all of the variation depends on how much you have in stocks. The goal of asset allocation is to choose a portfolio that gives you the best combination of risk and expected return for your particular financial needs. If you play it too safely, then you might not have enough money to retire when you want, even if things go well. But if you take too much risk, then if things go wrong, you might need to take a second job just to get by. Retirement might become an impossible dream. A good part of asset allocation is diversification. True, you can diversify your portfolio of stocks and eliminate as much as 70% of the risk you'd take if you held just one stock. Still, that leaves 30% of the risk, the market risk, that you can't eliminate. If you hold stocks, then you'll hold market risk. That's one reason why you might want to hold some bonds. They tend to be safer than stocks, and their value doesn't move in lockstep with the market.